Protect yourself against infectious diseases like coronavirus and lifestyle diseases like high blood pressure using ultra-modern medical equipment such as face masks, N95 and 3-ply face masks. Medical coverall suits and face shield masks prevents your body from getting in contact with a virus or bacteria. Often check your body temperature using infrared thermometer. Check your blood pressure using automatic blood pressure machines. This message is brought to you by Leviton Investments Limited, importers and distributors of high-quality medical equipment, located at Arowa Park Plaza, shop number 619 and 620 Bench, Wanoka Street. Leviton, caring for your health.
It is already tough economic times conditioned by the second lockdown. Now, what we are reading from Bank of Uganda is that about 150 billion has been drawn by commercial banks from the emergency provisions. Now, if you compare that amount to what was drawn in September last year, which was about 90 billion, now, it is quite something really, really big. But we'll be putting that into context in some of our subsequent shows. I am Charles Boyd, your host. Welcome to Man on Markets. Now, the 2021-2022 financial budget has been a mixed bag for many. There are those that are winning and those that are losing. Today, we're trying to put into context what this budget means to different players in the economy.
The budget for financial year 21-22 comes against a backdrop of very weak macroeconomic fundamentals, basically arising out of the effects of the pandemic. Now, the budget was aimed at recovery, setting parameters for economic recovery given the pandemic effect. As you know, government picks its revenue through taxation. Now, when economic activity is subdued, you do not expect much revenue generation by government. So we have to understand that background, because when you look back, previous budgets, of course, every year has its own challenges, but this particular year, coming from 2020, when the economy was literally shut down for about 4 months, that sets the stage for what one expected out of this budget. So by and large, this has been a recovery-driven fiscal position of government. So what you see as the focus areas, in terms of winners, and I want to look at this very broadly, you'd see that energy still stands out as one of the key sectors that government has focused on in the budget. Transport stands out, human capital development. Each of those sectors contribute differently towards economic development. For example, in the transportation sector, which took a big chunk of funds, you'll see that the government focus is to continue improving the transport network, especially in the Albertine region. Those roads which will facilitate the oil sector development and progress, so that transportation and linkage is made easier. When you look at energy, because also the theme is to industrialize industrialize, continue creating jobs through the strategy of industrializing the country. Energy is a big component into the whole ecosystem of production. So the focus for government was, let us continue improving the grid, look at rural electrification, increase access to electricity, make electricity cheaper so that production can be facilitated. The other one, which took also a lion's share, is human capital development. Human capital development really was the government focus, is how do we improve service delivery. So the issue was measures that can stimulate economic recovery by boosting business, private sector growth. You saw the allocation to the Uganda Development Bank, 103 billion, in addition to the 500 that was provided prior to this. So the focus there is affordable credit that can facilitate the private sector, investment promotion, then of course agro industry, and continuation of the infrastructure projects that government had started. So the 44.7 trillion budget, the focus mainly was how do we get the economy back on its feet against the backdrop of the pandemic effects. So, this to me was the key focus. Now, one of the things that stand out again is how this budget will be financed. I think the major issue here, and which is of concern, is domestic resource mobilization. How can government increase tax revenue to be able to meet the increasing government expenditure? Clearly, the targets are set a little higher than last year, 22 trillion that is expected to be collected by URA. But again, we have also to look at where is the revenue collection coming from. The past fiscal year, revenue targets were missed. And that also speaks quite a lot in terms of how you see things going forward. Is URA likely to meet the targets? That's $1 million question. The target now has been set to 22 trillion. I think it's a little high in my view, given now that we're going to be getting to a setback because of this new wave of the pandemic. We've seen already a quick, fast impact on what has happened in this month of June to date. Economic activity is depressed. We've seen this manifesting through so many angles. For example, if you look at imports, if you look at exports within this month, if you look at the exchange rate, the exchange rate is at a level of 3,500, a rate that we have not seen in a number of years. So one would ask a question, why is this? It's because there's no demand for dollars, there's no demand for Forex. Economic activity has stalled, and therefore importers are not demanding Forex cover to be able to bring in supplies. So it's starting off this way. So I can say that the new financial year has started on a very shaky ground.
In tough times, many of us tend to borrow, and even governments do that. For instance, today you're looking at huge debts for both households, businesses, but at the same time, government. So we speak to bankers to try and find out what the best way forward is under the circumstances. The country entered into the first lockdown due to the COVID-19 pandemic. Borrowers from the banking industry were given a window to restructure their loans. The restructured period was set to elapse in September of this year. Now, the big concern among financiers is whether these borrowers have been able to put their act together to settle the debt obligations currently running in trillions of shillings.
The relief measures are behind us. There are two sides in terms of what you expect to happen. If we were on the side of cautious optimism, we would be saying that we expect that everybody would have rearranged their businesses, maybe looked for new cash flow streams, and begun to manage their operations in response to what they've experienced over the last 18 months. Everybody gets back on stream and begins to service their loans. That is the positive scenario. If we take a slightly pessimistic view, to the extent that not everybody recovers and not everybody gets out of ICU from a credit perspective, what you would typically see is that there could be an upsurge of non-performing assets in the last quarter of 2021.
In the first quarter of 2021, the loans that applied for credit relief measures stood at 4.6 trillion shillings, which is half of the total amount at the peak of the relief requests in 2020. In general, non-performing loans had begun coming down with the reduction of COVID-related restriction measures, and optimism was beginning to emerge until now, when the new COVID wave kicked in.
What we have experienced over the last 1 month in terms of the second wave and the upsurge in the numbers, I think the impact of that is yet to be felt in terms of what it means for the economy. But going forward, I think it also does bring in a certain level of uncertainty in terms of what will 2021 be. Will it be truly a year of recovery? But that's the hope and desire that we all have, to say 2021 should be a year of recovery. It should be a better year. We have lessons learned from how we managed the first wave of the pandemic.
These fairly unusual circumstances are now rewriting the traditional functions of bankers.
From our perspective, we provide, advisory, business support and recovery advisory services. We have been sitting with most of the clients all our clients that we've provided credit relief measures, to try and relook at their businesses, look at their cash flows, look at their income streams, look at their operating costs, and also determine whether the current instruments, financing instruments that they are using, correlate with the sort of business that they are doing.
The COVID shock has not only impacted the household and business resource and debt standing, but also that of the national economy or government.
And COVID, of course, shocked our revenues. We had a decline in revenue. And then, of course, there was also a need to address the social aspects of COVID, but also the economic aspects of COVID in terms of the stimulus package. If you look at the resources we have put in COVID, we have put over 2 trillion, about 2.6 trillion has actually been put on as a result of COVID. So if there was no COVID, definitely our debt levels would be much less than they are now.
As it is at the moment, the economy seems to be riding in fairly uncertain waters, because at the moment no one knows for sure how much impact the second lockdown is going to have on the economy, and more so, how long this impact will last. Well, we'll now take a very short commercial break. Man and Markets continues after this break.